I'd like to invite my other panelists up to the stage as well. We can take some questions in this once we get this discussion going. I have James Wallbank from Ibaera Capital, who stepped in for us at quite late notice to help us out with the speaker dropout. And thank you, James. He's coming all the way in from Australia, and he's on a PE fund that invests across the junior mining and commodities spectrum. I have Jose Sanguinetti from Rimac Seguros, who's a large institution insurer in Peru, but he's the CIO for that business and looks at, again, investing across a lot of sectors, but largely into allocating into metals and mining as well, and on the equity side as well. So, gentlemen, thanks for getting us started this morning, and thanks, Kevin, for that opening presentation. I think I want to probe a little bit more on something that you said, Kevin, around why we think that the market's going to change. What are the sort of drivers that Crescat are picking up on? What are some of the areas that you think are going to sort of stimulate this institutional interest back into smaller caps, maybe exploration plays, and some of the companies that you've got in your portfolio there? You've got a lot of companies. Where's that third of successful companies going to see that capital injection to get them to the next level?
Okay, well, great question. I really believe the catalyst to get investors interested in commodities again, in gold and silver and other metals, really, it really starts with what you're already seeing in the Treasury bond market. And I mean, there's been trillions of dollars that has been lost in the last couple of years as the Fed has been forced to raise interest rates to fight inflation. It's a very real phenomenon, and I think there's more mayhem coming. It's not just the bond. It's not just the Treasury bond market. There's the junk bond market. There's mega cap tech stocks. There's the S&P indices at large. I think investors are going to be looking for something different. Maybe it starts with gold as a safe haven, commodity asset in this period of mayhem. Maybe it takes inflation to start rising again. I mean, we have wars, we have deglobalization, we have structural underinvestment in commodities for the last decade plus that are inflationary forces. And when people's traditional 60-40 stock and bond portfolios are going down, that's a large pool of capital looking for something different. Now, how does that money trickle down into the junior mining space? Well, it's going to take gold itself, breaking out above 2,000 and for real and running. But I think we're starting to see that. And then things can happen quickly. Things can happen very quickly. Things change. So I think it's coming.
Interesting. Jose, why don't you introduce yourself just to our audience here, and then perhaps get some of your commentary on those macro headwinds, and what's the institutional sentiment for looking at majors and then down the tiers into the juniors as well?
Well, yes. Good morning. Thank you very much for the invitation. My name is Jose Martinez Sanguinetti, and I run the investment portfolio for Rimac Insurance, which is Peru's largest insurance company. And we do invest on a global basis in equities, many times in mining firms. And we have had experience investing in junior firms in the past. What I believe is going to drive institutional interest in mining again at some point is, I think, is the fact that tech firms are massively overvalued, and at some point the market is going to notice that. And when they notice that, I mean, it's going to rotate into sectors that are more traditional. And there is a very strong underlying story behind mining at the moment because, I mean, if you look at the major economies in the world, they're all involved in very large infrastructure building efforts. I mean, the US, Europe, China, India are all putting an enormous amount of money into infrastructure. And I mean, that drive to invest in infrastructure is explained by the fact that the world is changing the way it moves, the way it generates electricity, the way it uses energy. And that's a very long-term trend that is going to remain there for quite a few years, maybe decades. And it's just a matter of time that at some point market does reflect that interest. Now, I do agree with the fact that if we look at what has happened over the last 10 years with developed economies, in particular the US, there's a massive accumulation of debt on the government side that is at some point going to, one way or the other, drive real interest rates to be very low. Not nominal interest rates, but real interest rates should be low over the next years if we expect the US to be able to meet its debt obligations. And the US is not the only country that has a massive amount of government debt. Most developed countries do have that problem. And when that happens, when real interest rates remain low for a long time, people are going to start looking into real assets. And then the interest for mining firms is going to rise again, I think.
Well, the million-dollar question then: when? When do you feel this is going to kick in, or this? We seem at a bit of an inflection point. Put it back to you. Are you positioning now for that to be to occur in 2024?
Do you mean?
Yeah.
Yes. Well, we are, but very slowly. We are, but very slowly, because we expect the market. We've all been talking about the recession that has not happened. We've all been expecting a market correction along with a recession that has not yet happened. It will happen at some point. So we're waiting. We're being very patient because, the massive fiscal effort that is being conducted by many developed countries at the moment is not going to let neither the economy slow down nor markets correct significantly. But it should happen when the recession becomes more evident. Many people are expecting that these may occur towards the end of 2024, maybe beginning of 2025.
Yep. Okay. James, let me bring you in. If you could introduce yourself and Ibaera Capital a bit as well, and then we can perhaps probe into some of this dynamic around, when's the risk capital going to come back into this sector, and how we develop these projects.
Sure. Thanks, Adam. Ibaera Capital is a private equity investment fund, so we don't generally participate that much in the listed market space. That's why you don't see us so much at these sort of conferences. But Ibaera Capital invests in mining. We started investing in what we call future-facing metals back in 2013, I think it was, and now I think future-facing metals gets a lot of coverage in the marketplace. And by future-facing metals, we mean copper, nickel, zinc, lithium. So that's what we've been doing since 2013. A technical team based in Perth. Typically, we're investing between 10 and 50 million US into individual projects in that space. We've always been top quartile performance in terms of investment returns. In 21 and 22, we were rated number one performing mining fund on the planet, which was great for us, but primarily because we've been investing in what people would know as battery metals, which have done really well over the last decade, particularly lithium. So what's happening in the marketplace? Look, headwinds and from the market are significant at the moment. We are going through probably the largest disruption in mining that we will have all seen in our lifetimes, and that is a change from burning fossil fuels to consuming metals required for decarbonisation. That's a significant long-term structural change. It needs significant long-term structural investment. At the same time, we have an investment market that's entirely focused on short-term investment returns. anything from a week to a year, which is exactly the sort of investment market that you don't want for long-term structural change. In addition to that, you look at what the regulators are doing, and you have, Biden with the IRA looking to promote investment into this space. You have the banks pushing up interest rates, trying to stop investment. You have Europe putting a tax on carbon. So what you have is a very volatile, uncertain marketplace. And when you come to answering questions about, what's going to change and when it's going to change, you have this sort of what we call it like a Cluedo marketplace. It's like, lithium in the dining room with a lead pipe. It's very specific. What investors see in Europe is different to what the majors see, which is different to what investors in the US see. So you have all these different investor spaces looking at different opportunities. That's why you have investment into US manufacturing. That's why you have investment into lithium, but you don't have investment into gold, which from an economic point of view is completely nuts. But you have this very irrational market space at the moment. And that creates a lot of headwinds and makes it very difficult for mining companies to go and fund and develop projects at a time where exactly what the world needs is long-term strategic commitment to investment in these sort of metals. Yeah. So it's like, I think bottom line is a tough marketplace at the moment.
Yeah, nicely framed there in terms of the confusing messages and the sort of regional differences as well. When you're talking to LPs, when you're raising capital, there's obviously like a bullish sentiment structurally around the battery metals that you've seen great success with over the last 10 years. But there's this bit of a disconnect in terms of how the smaller projects are going to come online, who's going to make it, how they're going to get their equity financing as well to get that project developed. So I wanted to focus on, how in this environment do you create value? Do you sort of continue to help these projects create value? How do you develop the projects and keep them moving along with this sort of these headwinds that you've all described here? Maybe we could start with you, James, and then work our way back down. Yeah.
Yeah, no, that's a great question. Look, just following on from what I said before, it's quite an irrational marketplace at the moment. Some LPs, in terms of large US institutional investors, get it, but I would say most don't. So what you're seeing is historically in the marketplace, we've, during the 2000s, we had China, which has the positive out of China, it has a long-term strategic view of how to invest. And that's sort of, washed over the marketplace. And while we had this very inefficient marketplace, we've had it for 20 years. We had China, which really created a long-term strategic view on, yes, I want to invest in steel and I'm going to put all this money in, and that's going to drive the marketplace. We don't have that now. So what you have, and I know it's a question you're going to have later, is we have different people entering the market, different people looking for investment opportunities. And so if you're a junior mining company, the issue for you is the traditional investors from even 3-5 years ago are different now. It's OEMs, it's battery manufacturers, car companies. It's philanthropists looking for, to be doing the right thing by the world. It's the Apples and the Chanels of the world that are really looking for these alternate sort of investments. And they're the people that actually have a strategic view on the marketplace. And I think generally you'll find that following them, the traditional US investor market is slow to the game. Following them, investment in the listed space, I think it's fair to say, is not strategic at all. There is not one iota of strategic interest in investment in the listed space. Albeit, I take, Kevin's point is saying here is a really great opportunity in the listed space. I totally agree. But fundamentally, the bulk of people that have been investing in the listed space, if you want to go and raise money to go and build a battery metals project, let's say it's not in lithium, don't go to the listed market space. Don't do a broker deal. I mean, there are lots of other sources of capital out there. They're really hard to find.
Yep. Excellent. Jose, any further commentary on that?
Well, yes. I mean, I believe that I mean there is a massive dislocation in the market at the moment, and but there's always been dislocations in the market, and that's when big opportunities arise. I mean, it's just a matter of being patient and a matter of holding to your beliefs and the way you understand the economy. I mean, it is true that the disruption that we are seeing now, in terms of the transformation that we're seeing in the world, has not happened before, and it will not happen for many decades. And it's going to produce a significant change in the way we do everything. And we are going to need a lot of metals in order to accommodate to those new trends. So it's just a matter of time.
Yep. What do you like at the moment in terms of the mining sector, or what's on your radar in terms of investments, and where do you position right now? Do you see a lot of opportunity in amongst the juniors now, or is it just a little bit too much of a risk-off environment to be allocating capital, so you're sort of getting your ducks in a row? Tell us.
Well, it depends. I mean, we are an insurance company, and insurance companies invest to match liabilities and obligations to insureds. So, I mean, junior mining firms would fit within our very long-term products. I mean, the ones that are, that have, I mean, that are sold on the basis of an expected appreciation over time, significant appreciation over time. As I said, I mean, we're being very patient about it, but we see an enormous amount of opportunities in both copper, in lithium, and particularly those two metals. I mean, that's one thing that is very important that we have not mentioned all, is that supply of metals is going to be restricted by geopolitical risk, and geopolitical risks that can take many forms. I mean, it can take the form of an armed conflict, but it can also take the form of social unrest in South America, in Latin America, where a lot of the lithium of the world and a lot of the copper of the world is sitting, and a lot of the gold and silver of the world is sitting. And we have very unstable governments in Latin America at the moment. And I mean, if you look at the numbers for private investment in most countries in Latin America, they're very small. I mean, private investment, foreign direct investment, is not growing significantly. The only country where it is growing is Mexico, and that's because of nearshoring. So that's another point that we have to take into account.
So resource nationalism sort of harming the appetite for investment in those jurisdictions.
It is indeed, yes.
Okay. Yep. Sorry, you were going to say on as well.
On resource nationalism?
Oh no, sorry. I was going to say, I thought you had another point there, Jose. But no, if you're finished, okay.
No, I agree with the sentiment that that the onshoring, the nearshoring, the investment opportunity in the G7 economies to replicate what China did in the decade of the 2000s. I mean, a lot of people are concerned. China's going through their own economic crisis right now. They're very likely not going to be the huge demand source that they have been. But the deglobalization, the nearshoring, onshoring, all of that, it's real. You have the Investment Reduction Act, they call it the IRA. It's not like your 401k plan or your personal IRA. It's a major government stimulus program here in the U.S. I think it's going to be the bipartisan solution once we're in the recession to getting the economy going again. And I think here in the U.S., between the Infrastructure Act, the CHIPS Act, and this Inflation Reduction Act, we have the fuel, to basically be what China was for the commodity investment boom of the decade of the 2000s, the U.S. alone. But it's not just the U.S., it's the whole G7 economies that are with the whole electrification wave, the decarbonization. I mean, the world, you need metals for the grid, for electric vehicles, for batteries, for windmills, for solar panels. We need metal, and we don't have it. So the investment opportunity, I think it's here, it's now. I don't think this distressed situation is going to last much longer, personally.
Yeah, it's interesting you mentioned China and sort of like the lack of the economy kicking back into the growth, the sensational growth that drove the last cycle, paper dragon, property crisis domestically, etc. China's got its own problems, but it's also got its own controls. Look at what they've done with graphite recently, just sort of stopped all of their exports, and they control so much of that market. So perhaps it's just a point of conjecture around what you're saying about the IRA and how the G7 are building out and sort of stimulating demand for metals. The processing piece, the midstream piece isn't there yet in terms of what China can do. Every bit of lithium kind of has to be processed in China before it then goes back to the US into one of the gigafactories, assembly plants. So my point is it's going to take a bit of time, right, to build out that infrastructure and to really create the facilitation of processing those metals. We sort of still need China to some extent, right? And therefore, at the moment, this supply crunch, the trade war it's not helping, really. It's not helping the situation kick on. Is that fair?
I think that's very fair. And to your point, China is not going away. They're still a huge force out there, and we rely on them. The world relies on them. We still import so much from China that we need. I mean, so they have a monopoly on solar panels as well. I mean, they control that market, and so there's, we may have these trade restrictions on China, but a lot of that stuff is getting out and into the world, and maybe it's coming through Mexico, but we're still buying it from China. And global trade is not going away, but there is this, yes, we got to kind of get into a recession first before the real fiscal stops get fully, before Janet Yellen and Jay Powell have the green light to be able to accommodate all the huge debt that we're pouring on the world, to do this. But these things can happen quickly, and we're on the precipice of all that right now, I think.
Yeah. James, you look like you wanted to chime in on something around the China dynamic. Is there a view there around whether that's, it's slowing down development in the sector in some respects?
Yeah, I don't think, I don't have a view that China's going to come to the rescue for funding development the way that it funded development in the steel markets through the 2020 zeros. But I think the positives out of this is that the governments, the US government, European government, gets it and is taking action to stimulate investment in the space. The positive is that structurally the metals marketplace for these critical metals is here and is here to stay for at least the next 10 to 20 years. So it's a good space to be investing into. I think the challenge is going to be where those streams of capital are going to come from, and when they're going to come to marketplace. And the Reserve Bank coming out and saying, we see interest rates higher for longer is not a particularly positive signal to the marketplace to come and invest your money into relatively risky investments, as Kevin suggested, such as mining, when you can get 5.5% by sticking your money in the bank. So that's not particularly positive, but I I would agree that the US and European markets are going to stimulate. We will ultimately underperform in terms of decarbonising. That's just going to drive up prices, and the market will get it sooner or later. But I just think it's going to be later rather than sooner at the moment.
Yep. Okay. Excellent. I wanted to talk about the M&A cycle, and then also the view from the majors as well. So what role are the majors playing, and what should they be doing more, perhaps, in terms of stimulating development of grassroots exploration projects, etc.? Kevin, you had some thoughts on a new M&A cycle ensuing. What are some of the drivers behind that? Why are we going to see that?
Well, ultimately, it's this idea, it's a supply-demand imbalance, and the idea that we are going to see all this huge fiscal stimulus ramp up once we get into the recession. I mean, yes, there is going to be more economic and financial crisis first. That's what it's going to take to get gold breaking out and running above $2,000. And personally, I believe that the Fed is trying to, and it's not their mandate, it's not their job. I believe they're trying to create a recession, because that's what they've done. They've raised interest rates so high, and real interest rates are so high right now that a hard landing is unavoidable. And yes, that's making people not want to invest in mining companies today, because you can get 5.5% in Treasury bills, and that seems like a pretty good deal. But the reality is that we've had this massive underinvestment in commodities, in metals already now for over a decade. And the junior mining industry, actually, if you look at the TSX Venture Exchange Index, which is dominated by these junior mining companies, it reached its prior high like 16 years ago. I think it was like in 2006. Okay, so this has been a long, depressed cycle that is ripe to turn. The opportunity to invest, I think, for the smart money is now, while things are distressed, and appealing to the masses of investors in their 60-40 portfolios, to be interested in gold again, because they've been burned on gold and gold miners during the 16-year bear market. It's gonna take gold breaking out. It's gonna take them seeing the performance in these companies starting to go up again. But as a smart investor, I think we want to get ahead of that trend. We want to be there. We want to have the product for when the money is really getting ready to allocate to commodities and out of those 60-40. I think it's coming faster than most people know, but it's the massive underinvestment that's the setup. So the question was, the majors, what's it going to take for them to get going into this M&A cycle? They're like Jay Powell. They want to see a crisis first, so they can come in, and get the best possible deal, that they can. But they're not going to have much time, because gold is on the move again. It's above 2,000. They've created this problem partly themselves, because they haven't been making the investments over the 16-year period. They haven't been investing in new discoveries on their own. There hasn't been a lot of M&A.
Resource replacement is their challenge, right? But surely they've had the shareholders said, don't go out and buy risky projects, right? Because
they're facing a massive supply cliff, because the investors they spent like drunken sailors in the last cycle. One of the charts I showed all the takeouts in the last cycle in the 2000s, and how many stupid deals that the majors did, and the shareholders, were not happy, and so. But
is that still holding them back now after all this time with the resource replacement challenge that they're facing? There needs to be some relevance amongst the majors now, and this is like this cliff, this M&A cliff you're talking about.
the reality is they're facing a production cliff because they haven't been replacing their reserves. They don't have the good projects. So they're going to have to buy the junior mining companies that have the best projects out there. They have no other choice. They haven't been doing their own organic exploration. They've abdicated it to the juniors. Everyone's waiting. Well, when are they? You know, there was Ken Ross has been more active than others, and they bought Great Bear who was it? They also bought Ken Ross seems to be one of the more active ones. No, it was B2 Gold bought the deposit in Nunavut. You know, there's been a little bit of activity, you know, but you know, I know they're the major mining company. You know, Quentin, our expert, he worked at the major mining companies. He knows so many people there. I mean, our companies in our portfolio are engaged with these companies. We know there is stuff that's going to be happening, and so it's coming. The world needs this stuff.
Yep. Okay. Does anyone have any questions for a panel at all at the moment? Yep. Down here, lady from Merrill's. Wait for a microphone. Thank you.
Thank you. Here in America, given reshoring and inflationary pressures, is it more expensive to develop and explore in the U.S. versus in other countries? And where are you looking to develop mines more? And how would that factor affect the valuation of these projects?
Great question. Anyone like to tackle that? Kevin, you have a lot
well,
of...
you know,
yeah.
I'll just chime in for my 2 cents. I think the, you know, every jurisdiction has its advantages and its disadvantages. And U.S. is a little bit higher costs, a little bit higher to get permits, but it depends what state you're in, you know, and you know, there is more easing up in the, we think even in the current administration with the IRA, for instance, in terms of, but potentially in the time to come and being open to more projects. I mean, but Bolivia, we have 2 investments in Bolivia, 3 actually, and we actually think it's probably the best place to build a mine and get it into production, probably faster than you can anywhere on the planet right now. And we've had success in that with one company, with San Cristobal already, and have 2 other investments there. A lot of people are nervous about nationalization in South American countries and Central America, that risk. It's a risk. We're more concerned about that risk in Chile right now, and you know, we like Peru. You know, we divested in Mexico of almost all of our Mexican projects a couple of years ago, given the way that the political environment there was going. But there's lots of great places to build mines around the world. We like Canada, but Canada is kind of expensive, as well, and dealing with, you know, First Nations, always a challenge in the U.S. and Canada. I mean, mining is not easy. It's one of the reasons there's only a few companies that really ultimately do make it and are the big successes. But the world needs these world-class mining projects, and I think there's going to be an easier road, a little bit easier road ahead from an investment standpoint in terms of state government sponsorship. You know, it's going to take getting into the recession and realizing that it's more of a stagflationary recession that we're facing, because we don't have the critical things that we need for human civilization and for these big ambitions on the electrification side. But you know, costs are different and opportunities are different in every jurisdiction for so many different factors.
Yep. Is it fair to say that permitting is a massive challenge? If we're thinking US-centric as well, permitting is holding things up despite these positive momentum from like IRA and sort of the need for domestic projects or sort of changing the supply chain.
Yeah,
James.
Go ahead.
Yeah, look, I think there's lots of challenges that face development in the space, and there is a lot that governments can be doing to support mining investment. Just to put it in context, I think McKinsey came out with a report earlier this year, I think mid-year, on investment in metals for decarbonisation, and said, I think their statistic was currently in copper, nickel, lithium, there's around 560 mines, I think it is, operating in the world. And in order to meet our base case requirements for decarbonisation, we need about another 150 mines between now and 2030 in the next 6 years, and we're doing about 1 to 2 new mines a year. So we're going to miss by about 95%, unfortunately. So we're a long way away. We're not missing this by a little bit. We are missing this by a long way, and there are a number of levers that governments can potentially pull to stimulate investment and make investment easier in the US, in Canada, and Australia, in the emerging markets and so forth. So that's what government needs to do. They need to make investment a lot easier in the mining space if they're serious about achieving decarbonisation targets.
We've got 2 minutes left. Unless there, Jeffrey, yeah, let's get a question down here.
I have a question for all three gentlemen, and it's that in view of the fact that we're today facing a crisis in the sense that you've got the lowest inventories in most of these metals in history. How much will a steep recession alleviate this, or won't it alleviate it at all?
Well, when it comes to the demand side of the economy, the Fed can create a recession by raising interest rates, and that's what they're trying to do, to tamp down demand. But it doesn't do anything to increase supply, especially if you're starving mining companies of the capital that they need to develop metals. So we are indeed going into a crisis. That's going to be very good for metals prices. So, I mean, that's what we all are going to have to see first, is prices going up. So supply deficits are going to be a part of creating the crisis, and what I believe is going to be a stagflationary type of a recession.
Yep. Final thoughts on that?
I think we got to overlay this context of traditional market economics with actually what's happening in the marketplace, which is material dislocation. And in an environment of material dislocation, traditional markets don't perform. They're not going to come and save us. So you look at the marketplace and you say, look, supply is not coming to market. All-time historical lows in terms of material inventories. All the projections, IEA, there's plenty of reports out there that of what's required in order to meet these objectives. But there just isn't from the traditional investor base, you get the deer in the headlights. Yeah, but I don't invest in mining, or yeah, this is difficult, or the majors want to stick to their knitting. The majors don't want to go and invest in exploration. They want to go and buy another operating mining company. That's what they want to do. So there's no clear saviour in the marketplace to bring funding. It is just going to be a matter of market forces putting so much pressure and creating so much upside in terms of valuations in the mining space that money finally starts to flow. But, as Kevin was saying before, I mean, we're returning 20% year on year. It's good time for people that are investing in the marketplace where, making a lot of money. Kevin's making a lot of money, 30%. That's great. But, I think McKinsey said between now and 2030, we need $3 to $4 trillion of investment. $1 trillion of investment. you know, it's a big number, and you know, Kevin and I can try, but you know, I don't think, and Jose, I don't think between us we're gonna get there, you know, but it is a good time to make money. Money can be made in the marketplace, but it still doesn't solve the funding solution for a lot of the junior companies here today.
But the recession may help bring down interest rates, which will probably lower the cost of capital and trigger the next wave of investment into mining, which that's what we're all expecting.
Yep. Okay, well, look, we're out of time. It's been excellent. We covered a lot of topics there. Plenty of opportunity, plenty of risk, as ever in our sector. But look, let's continue with our sessions. But thank you to my panelists.